Most Roth conversion advice out there is way too simplistic and in some cases dangerously simplistic. You'll often hear things like just convert to the top of your 24% bracket or do it early to avoid RMDs, which is not bad advice. I've said these things myself in previous videos, but in reality, retirement tax planning is nuanced. It's multi-layered, interconnected, and it's easy to mess up if you don't understand how the pieces fit together. Even a small mistake like converting just a few $1,000s too much can trigger a ripple effect. Your Medicare premiums can spike by thousands of dollars, more of your Social Security gets taxed, you might owe more in state taxes, and if you're retiring before 65, you can lose healthcare subsidies. So in this video, I want to walk you through how some of these traps work and how to avoid them so you can build a Roth conversion plan that actually reduces taxes over your lifetime. Let's dive in. Let's start with the most costly mistake retirees make when making Roth conversions. That mistake is making decisions solely based on your federal tax bracket. For example, we're in the 12% bracket and convert X amount to stay within the 22% bracket. On the surface, that sounds really reasonable. But what's missing is that the federal income tax is just one of 5 considerations to weigh in retirement. And this is the reality that most advisors don't explain. Your taxable income affects more than just your income taxes. It determines how much of your Social Security gets taxed, whether you trigger Medicare IRMAA surcharges, whether you lose health insurance subsidies if you retire early, what your state taxes will look like, and how your deductions and credits might be phased out. Let's look at IRMAA as an example. If your modified adjusted gross income crosses just $1 over the 2025 IRMAA threshold, which is $212,000 for couples, you could be paying thousands of dollars more per year for Medicare Parts B and D. Here's another example. Marketplace subsidies. If you retire at 62 and lose even a portion of your subsidy due to a Roth conversion, that can be $5,000 to $10,000 in extra premiums, which is money that came straight out of your supposed tax savings. In Social Security, a modest conversion can turn what was originally untaxed income into mostly taxable benefits, pushing your effective marginal rate far above what you had anticipated. Let me give you another example. A couple I worked with, let's call them John and Jane, converted $75,000 to their Roth in 2024. They thought they were staying under the 24% federal bracket, which they did, but the conversion pushed them over the IRMAA tier, which increased their healthcare costs and made 85% of their Social Security income taxable, all of which culminated in bumping them into a higher state tax bracket. So all in all, the 22% conversion actually cost them 50 cents on the dollar in effective taxes and penalties. So that's the reality of retirement taxes. Let's dig a little deeper though. To truly understand why so many Roth conversions can backfire, you need to understand and look at how retirement taxes work behind the scenes. So let's break down what really happens when you convert, let's say $50,000 from your traditional IRA to a Roth IRA during retirement. Step 1 is federal income tax. This is the easy part. You pay 22 or 24% as an example, depending on your income, but that's where the simplicity ends. Step 2 is Social Security taxation. The IRS uses what's called provisional income to determine how much of your Social Security is taxable, and you guessed it, Roth conversions add to provisional income. So suddenly, 50 to 85% of your Social Security benefits will become taxable even if they weren't before. So that's more taxable income, more tax, and it came out of nowhere. Step 3 is Medicare IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge slapped on top of your Medicare premiums when your income goes above certain thresholds. In 2025, for married couples filing jointly, if your income crosses just $212,000, you'll pay over a couple $1,000s per year in premium surcharges. Step 4 is Affordable Care Act subsidy loss. If you're under 65 and relying on marketplace health insurance, a Roth conversion can kick you off your subsidy completely. That's $5,000 to $10,000 in extra premiums, not because of the conversion itself, but because of what it did to your reported income. And then finally, step 5 is state income tax. Depending on your state, that $50,000 conversion can cost you another 5 to 10% in state income taxes. So what looks like a 22 or 24% tax bill suddenly is a lot more. This is why the sequence and the size of your Roth conversion matter a lot more than the basic tax bracket that you're in. And this is exactly why the 2022 Boston College study found that retirees with modest incomes were paying extremely high effective marginal rates once all of these factors were stacked together. So if you want to avoid the costly mistakes, forget the old rule of thumb. Simplistic advice is too incomplete for a nuanced retirement landscape. Instead, think of Roth conversions the way a surgeon thinks about an operation: precise, measured, and personalized. So here's the framework that I use with my clients. Number one, understand your effective retirement tax rate. Again, it's not just about your federal tax brackets, it's about your effective retirement tax rate. This is true for every extra dollar of income that you factor in from Social Security taxation, IRMA cliffs, Affordable Care Act subsidies, state taxes, and capital gain and deduction phase-outs. You need a full map of how income impacts each one of these before converting a single dollar. Number two, use your low income years strategically. The best time to convert isn't necessarily now, it's during your low income years. That is the period after you stop working, but before Social Security and RMDs start. For a lot of retirees, it's the sweet spot between age 60 and age 72. During those years, your income may be lower than it ever will be again, so use that time wisely to do controlled, threshold-sensitive conversions that avoid IRMA and tax cliff triggers. Number three, layer conversions with smart withdrawals. You don't have to choose between converting and spending. They are not the same thing. Smart retirees convert just enough to avoid tax traps while using after-tax savings, HSA funds, taxable accounts, or a structured drawdown plan to fund their lifestyle. This not only reduces your future RMDs, but it gives you tax-free income and flexibility down the road, which matters the most. And finally, number four, stop optimizing for this year's refund. One of the most dangerous mindsets in tax planning is focusing on what saves you the most this year or next year. Roth conversions are rarely about this year. It's about controlling the next 10 to 20 years. They're about reducing RMD pressure in your 70s, locking in lower tax rates before brackets reset, and giving you more tax-free flexibility when long-term care or legacy planning comes into play. So in the next section, I'm going to show you how to know if you're doing it right and what a successful optimized Roth strategy actually looks like in practice. Now, if you're watching this and thinking this is a lot to keep track of, you're absolutely right. If you're looking for support from a fee-only financial planner, I would love the opportunity to support you. Head over to my website at hawaiiadvisor.com to schedule a free intro call. And if you plan on going it alone, here's how you know that you're doing it right. Number one, you have modeled all 5 of the tax layers. You've looked beyond just your federal tax bracket, and your conversion plan accounts for IRMA thresholds, Social Security taxation, Affordable Care Act subsidy cliffs if you're under 65, state income tax, and capital gain stacking or deduction phase-outs. If you're not seeing how each dollar of conversion ripples across all these categories, you could be flying blind. Number two, you're converting within strategic limits, not just your brackets. So don't convert just the 22% federal bracket. Instead, you convert just enough to stay below the IRMA thresholds for this year, and in the 2-year look-back window, you're under the Affordable Care Act cliffs if you're pre-Medicare, and you've calculated the tax cost as being optimal. In other words, you're making precise measurements and not just using rule of thumb. Number three, you're coordinating your conversions with your cash flow. Your conversion plan should ideally not eliminate all of your taxable accounts. You should be covering taxes with non-retirement assets or using smart timing so you don't have to sell investments during market dips just to pay Uncle Sam. Roth conversions are helpful, but not when they force you to damage your portfolio or make you imbalanced to fund them. Number four, you know your guardrails. A truly optimized plan has a range for when to convert, how much to convert, and what to avoid. These guardrails should map your income ranges from year to year so you know what you can do, what you should do, and what would push you into the danger zone. That is the difference between hoping a strategy works and knowing that it will. And finally, number five, you've shifted from reactive to proactive. If you're thinking more than a year ahead, so not just about your refund, but about your RMDs, your IRMA exposure, and your retirement income mix, you're already ahead of 95% of retirees. Because the truth is, when Roth conversions are done with precision, they can give you tax-free income in your 70s and 80s, flexibility when healthcare costs rise, and confidence that you won't be caught off guard by a surprise tax bill. So Roth conversions, when done right, gives you more flexibility, less tax risk, and a greater peace of mind in retirement, but done wrong, they can quietly cost you thousands of dollars. If you want help building a smarter retirement plan that includes Roth conversions, again, I would love the opportunity to support you. I'm Daniel Masuda Lehrman. I'm an independent fee-only certified financial planner based out of Honolulu, Hawaii, and serving clients virtually nationwide. Click the first link in the description to schedule an intro call, and let's see if we're a good fit. Thanks so much for watching. Make sure to like and subscribe. I'll see you in the next one.